Gold hit $5,000 on February 19th, 2026, and now it's holding there for a third straight day while the Fed is openly discussing raising rates. Something doesn't add up, and what's happening behind that number is far bigger than most people realize. Welcome to Market Flux. If you are new here, I break down what is actually happening in markets while mainstream media keeps you distracted. Subscribe right now, because what I am about to show you could change how you see gold and every other asset in your portfolio. Let's start with exactly what happened. On February 19th, 2026, spot gold officially crossed the $5,000 per ounce mark for the first time in history. That is not a rumor. That is not a forecast. That is a number that printed on exchanges around the world. In less than 2 years, gold has gone from approximately $2,150 in January 2025 to $5,000 by February 2026. That is a 75% gain in 24 months. And right now, on February 20th, 2026, gold is consolidating around that exact $5,000 level. The 100-hour simple moving average sits at $4,165 or $41 as immediate support. Here is what matters today. The market is not moving, it is waiting. Traders are holding their breath ahead of two massive US data releases. The advanced Q4 GDP report and the Personal Consumption Expenditures Price Index, the Fed's preferred measure of inflation. These two numbers, dropping today, will either confirm or destroy the narrative that the Federal Reserve is done fighting inflation. And that decision will move gold by hundreds of dollars in either direction. Now here's the part most retail investors completely miss. The reason gold is not crashing despite a suddenly hawkish Fed is because there are two completely opposite forces colliding at $5,000 right now. Think of it like a car with the engine running full throttle and the brake pressed at the same time. The tires are spinning, the car is not moving, but enormous energy is building underneath the surface. Force number one is the Federal Reserve. The January FOMC meeting minutes, released earlier this week, showed that central bank officials are not just pausing rate cuts. They actually discussed the possibility of raising rates again if inflation does not cool. That is significant. The market repriced Fed expectations immediately. The US dollar surged to its highest level since January 23rd, 2026. A stronger dollar is kryptonite for gold because gold is priced in dollars. Force number two is geopolitics, and this is where it gets serious. On Thursday, February 19th, US President Donald Trump issued a direct warning to Iran. He told them to make a nuclear deal, or really bad things will happen. He gave a deadline of 10 to 15 days. Iran responded by telling the UN Secretary General that while it does not seek war, all bases and assets of a hostile force in the region would be legitimate targets if attacked. The US military, according to multiple reports, is reportedly positioned to act as early as this weekend. Ukraine-Russia talks concluded in Geneva on Wednesday without a breakthrough. Substantive disagreements over eastern Ukrainian territories remain fully intact. The world is not calming down. It is escalating on two separate fronts simultaneously. Now, let's talk about the three reasons this is happening and why the mainstream financial media is only giving you half the story. Reason number one is dollar decoupling. Gold has historically moved inversely to the US dollar. When the dollar goes up, gold goes down. That rule is fractured. Both gold and the US dollar have been rising together in early 2026 as investors flee what analysts are calling systemic anxiety about massive US national debt and the perceived erosion of Federal Reserve independence. That is not normal. That is a warning signal. Reason number two is central bank buying at a scale most retail investors do not understand. Central banks led by the People's Bank of China and the Reserve Bank of India began an aggressive diversification campaign away from U.S. Treasuries starting in February 2025. And by early 2026, these institutions had collectively purchased over 1,200 tons of gold for the third consecutive year. Central banks bought gold at record levels through 2025 and into early 2026 as part of de-dollarization and balance sheet diversification, with sovereign buying making up approximately 20 to 30% of annual demand. They are not buying because gold is going up. Gold is going up because they are buying. Reason number three is that the Fed's own credibility is now a factor in gold pricing. Fed Chair Powell's term ends in May 2026. That could mean heightened volatility in interest rate expectations. Trump has already named Kevin Warsh as the next potential Fed chair. Markets are pricing in the possibility that the institution itself becomes politically influenced, and that is deeply bullish for hard assets like gold. Now here is the big player versus retail disconnect you need to understand. While retail investors spent February watching gold pull back from $5,119 down to $4,841 and panicking about whether the rally was over, institutions were doing something completely different. As the $5,000 barrier fell, the SPDR Gold Shares ETF saw record-breaking intraday volume, reflecting a massive shift in institutional capital allocation. JP Morgan Global Research is forecasting gold to average $5,055 per ounce by the final quarter of 2026, rising toward $400 per ounce by the end of 2027. While retail investors were asking, should I sell? JP Morgan was publishing $400 price targets. JP Morgan projects around 585 tons of quarterly investor and central bank demand on average in 2026, comprising approximately 190 tons a quarter from central banks alone. They are not watching this from the sidelines. They are accumulating. The retail investor was told gold was overextended. The institution was told gold has 8% more upside just to hit year-end targets. But here is what most people completely miss. The data coming out today, the GDP and PCE numbers, are not just going to move gold for a day. They are about to set the direction for the next 3 months of the most consequential precious metals market in a generation. Gold has been rising for 3 straight days while the Fed is openly debating rate hikes. That tension does not resolve quietly. It explodes. And today's GDP and PCE data will light the fuse in one direction. Here is what history tells us happens next, and what you need to do before most people figure it out. Let's go back to August 2018. The Fed was in the middle of an aggressive rate hiking cycle. The US dollar was strengthening. Every mainstream analyst was calling gold dead. It dropped to $1,174 per ounce. Then geopolitical pressure built. Trade war tensions escalated. The Fed pivoted. Gold ran from $174 in August 2018 to $2,075 by August 2020. That is a 76% gain in 24 months. Sound familiar? We are watching the same structural setup replay right now, except the numbers are bigger, the geopolitical risks are more acute, and the institutional buying is 3 times more aggressive than it was in 2018. History does not repeat exactly, but it rhymes loudly enough to pay attention. Now let's talk about what has not changed. The 4 structural pillars still fully intact underneath gold's move. Pillar 1 is central bank demand. As covered in Part 1, sovereign institutions are buying approximately 190 tons per quarter. That pace has not slowed. It has not reversed. It is the structural floor underneath gold's entire price. Pillar 2 is the U.S. fiscal situation. The U.S. national debt crossed $36.2 trillion in January 2026. Interest payments on that debt now exceed the entire U.S. defense budget. When a government is paying more to service its debt than to fund its military, markets start looking for alternatives to that government's currency. Pillar 3 is geopolitical escalation. Trump's 10 to 15-day Iran deadline expires in the first week of March 2026. Any military action in the Middle East historically triggers an immediate 3% to 5% single-session spike in gold. Russia-Ukraine talks remain deadlocked. 2 active conflict zones simultaneously is not priced into most portfolios. Pillar 4 is the de-dollarization trend. The BRICS nations, Brazil, Russia, India, China, South Africa, plus the 6 new members added in 2024, are actively settling more bilateral trade outside the US dollar system. Every trade settled in yuan, rupees, or local currencies is one less transaction creating demand for dollars. Less dollar demand means more gold demand over time. None of these 4 pillars have cracked. All 4 are intensifying. Now I am going to go on the record. Screenshot this. By June 30th, 2026, gold will reach $5,500 per ounce. Here's the logic. The January 2026 FOMC minutes spooked markets temporarily. But the PCE and GDP data releasing today, February 20th, 2026, will show one of 2 things. Either inflation is cooling, which gives the Fed room to cut, immediately bullish for gold. Or inflation is still hot, which confirms the stagflation scenario, a slowing economy with persistent inflation, which is historically the single most bullish environment gold has ever performed in. Either outcome points the same direction, up. The 100-hour SMA support at $4,165 holds as the floor. The next technical resistance above $5,000 is open air until 5,119, which is the recent high. After that, $5,150 is the next meaningful level. $3,500 by June 30th is not a stretch. It is math. Now let's talk about scenarios and probabilities, because not every outcome is guaranteed. Scenario 1, gold breaks above $5,119 and trends toward $5,500 by June 2026. Probability, 65%. This happens if today's PCE data comes in above 2.8%, confirming stagflation fears, or if the Iran situation escalates militarily in the first week of March. Scenario 2, gold consolidates between $4,800 and $5,100 for the next 6 to 8 weeks as the market digests the Fed's hawkish tone. Probability, 25%. This happens if today's GDP print is stronger than expected, the dollar holds its recent gains, and the Iran deadline passes without military action. Scenario 3, gold sees a sharp correction back to $4,600 or lower. Probability, 10%. This requires a complete Fed pivot back to rate hikes, a sudden resolution in both Ukraine and the Middle East, and a surge in dollar demand. All three at once. Possible, not probable. Now here is what you should actually do, depending on where you are right now. If you're holding physical gold, do not panic over daily consolidation. You are positioned on the right side of every structural trend: central bank buying, de-dollarization, fiscal deterioration, and geopolitical risk. Your job right now is to hold and let the thesis play out. The $4,165 SMA is your reference point. As long as weekly closes stay above it, the trend is intact. If you are using leverage or actively trading, today is a high-risk session. The GDP and PCE releases will create violent short-term moves in both directions. Do not get chopped out of a correct long-term position by short-term volatility. If you are trading, reduce size ahead of the data. Let the number print first, then position. If you're sitting on the sidelines with cash, you're not late. A consolidation between $4,800 and $5,100 is exactly the kind of setup that precedes the next leg higher. Watch today's data. If gold holds $4,965 after the PCE print, that is your signal. Staged entry across 2 or 3 tranches is smarter than waiting for a dip that may not come. If you bought near $5,000 and are now watching it consolidate right at your entry, understand what you own. You are not holding a speculative trade. You're holding the asset that every central bank on earth is also holding. You are early to the institutional reallocation that the next decade will be defined by. Patience is your edge right now. Now here is what to watch going forward. These are your 4 indicators. Watch the PCE price index. Today's release is the Fed's preferred inflation gauge. Above 2.8% year-over-year confirms stagflation. Below 2.5% reopens rate cut conversations. Gold reacts within minutes of the print. Watch COMEX gold inventory levels. When physical gold is being withdrawn from COMEX warehouses in large quantities, it signals real demand, not paper speculation. Watch the weekly inventory reports published every Thursday. Watch the DXY, the US dollar index. If the DXY fails to hold above 107.50 in the next 2 weeks, dollar weakness returns and gold's path to $5,500 accelerates meaningfully. Watch the Iran situation between now and March 5th, 2026. If Trump's deadline passes with military action, that is a single session spike event. If it passes with a negotiated deal, expect a brief gold pullback of 2% to 3%, a buy opportunity, not a trend reversal. Now, 3 types of people are watching this video right now. The first type is panicking. They saw gold hit $5,000, told themselves it was too high, and either sold or never bought. Now they're watching it hold. Every day it holds $5,000 feels like a personal mistake. They're waiting for a crash to feel vindicated. The second type is frozen. They know the thesis makes sense. They have done some research, but they cannot pull the trigger because every time they get close, a headline about the Fed or a strong dollar makes them hesitate. They have been frozen since $4,200. The third type is learning and preparing. They watched part 1, they stayed for part 2. They now understand the mechanism, the historical pattern, the structural pillars, and the scenarios with probabilities. They are not going to be caught off guard by whatever the PCE print delivers today. They know what to watch and they know what it means. The third type is who this channel exists for. Here is the truth about markets that no one on financial television will say out loud. Every major wealth transfer in financial history followed the same pattern. The informed accumulated while the uninformed debated. The patient held while the impatient sold. By the time the majority understood what was happening, the move was already 80% complete. Gold at $5,000 is not the end of the move. Based on every structural indicator available on February 20th, 2026, it looks much more like the midpoint. We started this video with a question: why is gold rising for a 3rd straight day when the Fed is talking about raising rates? Now you understand the answer. It is because the geopolitical risk is bigger than the Fed. The de-dollarization trend is bigger than the dollar, and the institutional buying floor is bigger than any short-term technical resistance. If this video gave you clarity that no one else is giving you right now, hit like and subscribe. Share this with one person who is frozen right now, someone who knows gold is important but cannot figure out which way it is heading. Send them this video and drop 1 comment below. I want to know, are you holding gold above $5,000 or are you still waiting on the sidelines? Type holding or watching right now. I read every single one. This is Market Flux. I will see you in the next one. This video is for informational and educational purposes only. It is not financial advice. Always do your own research before making any investment decisions.